All right, welcome back everyone. Today's video is going to be quite the educational one actually, because ever since I started this channel that's focused on intrinsic valuation and valuing businesses, I've got an endless request on creating a DCF tutorial. So today we will be looking at how to create a free cash flow to the firm model all the way from scratch. Now, keep in mind that just because you have a model does not make it a valuation, and we will get into that later. But jumping right into it, we have a completely blank slate, and by the end of this, you will be able to make your own free cash flow to the firm model all the way from scratch, from a blank slate, and you will be able to make something like this Tesla valuation or this Palantir valuation. And Palantir is actually the company I want to make a mock DCF for. So keep in mind, this is not an actual valuation. The inputs are gonna be just for illustration purposes only, educational purposes perhaps. But let's get right into it. Intrinsic valuation has been around for a very, very long time. It's been centuries that businesses have been bought based on growth, cash flows, and risk. And a DCF model is a simple tool in order to derive intrinsic value. So first things first, we need a projection period, because this model is based on our projection inputs for the future. And then we will bring it back to present value. So basically we have, let's do 2023 as the base year. That's already happened, so it's historical. It's not going to be any projections there. Let me just do this +1. And you can follow along in Excel. You can follow along basically using Google Sheets, whichever one you want. So we're gonna do periods. And the reason we do this is to make it easier later when we do the discount factor. But don't worry about that for now. So first we need to designate how far out we're going to project. Now, some people do 5 years. I think it doesn't really capture much of future performance. Of course, it's much easier to only do 5 years rather than 10. So I get the appeal to that, but I typically like to do 10. Now, ideally, you would model all the way until the business succumbs and dies, all the way to maturity and beyond. We won't be doing that because one, the discount factor just becomes way too large, and two, there's no way we can even have any semblance of accuracy that far out, especially for a relatively young company like Palantir. So here you can basically 2024, we have still one reportable quarter for Palantir. So what we can do is we can do a quarter of a period rather than a full period. And the reason I did this +1 is just to make it easier forwards. So yeah, 2034. So we have basically 10 years and a quarter. Now you can do it like just start from a base of 1 and then just do to 2033. You have 10 periods, but it's not really accurate because there's only one quarter left. So we do 0.25 and then we just add on 1 for each subsequent year there. But before we get into the meat of that, we actually need a key input into the future. And you might have guessed it, you might have not, but I will tell you anyways. We need a discount rate. Now, there are many ways to go about creating a discount rate. I will tell you what I do. You don't have to agree. There is a weighted average cost of capital formula, a WACC formula that you can use, and that's what they teach you in business schools on how to do, where you look at the beta, the stochasts, and stuff like that. But I completely disregard that because I don't believe it captures the risk of future cash flows properly. So what I do instead is I have two completely market implied variables here. So one is the risk-free rate, and the second one is the equity risk premium. And then the third one I have is business specific risk. So what are these inputs? first, the risk-free rate, it's pretty self-explanatory. It's what the current yield is. In this instance, it's the 10-year US Treasury yield. You can use any equivalent for any market you want to value a business in, but I will use the 10-year. Let's just make this into percent. Let's add some decimal points so it's nice and clear for us. Now, if you use a discount rate of 4.57%, that's the implied charge that you are expecting for taking on the risk of investing in equities. Now, if I told you, you can get an annual 4.57% by investing in a stock, would that sound attractive to you? Well, no, it wouldn't, because you can get that completely risk-free as of right now through the US Treasury yield. So the question then becomes, how much more would you charge in order to take on the risk of equities? And you can actually calculate the implied equity risk premium by looking at what investors are, as of right now, charging for taking on the risk of equities. And that's by looking at the market and the expected future cash flows of the market and the investor activity in the markets. Now, Aswath Damodaran calculates this on a monthly basis, so I simply just go to his website and grab it every month, every time I do a valuation. So if we're in the month of January, as we are at the time of this recording, I just go to his website and he has already calculated this, and he provides the means for you to calculate it yourself if you somehow doubt Professor Aswath Damodaran. I will put a link into the description there if you're interested in the implied equity risk premium. But yeah, it's basically what's currently implied that investors are charging to take on the risk of equities. Obviously, it's not going to be zero, because then there would be no point in owning stocks. You could just own the US Treasury yield if you're only expecting to make whatever the risk-free rate is. So now we have our first two components of the discount rate. And then we have the third one, and this one is kind of tricky. So already we have 8.62%. This one is kind of tricky because different businesses have different risks of acquiring our projected future cash flows. And for Palantir, there's a lot of execution risk, a lot of sales risk, scale risk. For a different kind of business, let's say Robinhood, popular stock right now, there's a lot of cyclicality risk. Sometimes markets are really hot, there's a lot of volumes in the markets, people are buying options, which means Robinhood is gonna make a lot of money. Sometimes, if we enter a recession, if there's some macroeconomic factors making investors fearful, Robinhood is not gonna be making as much money. So here we need to introduce business-specific risk. And basically, I could make a separate video on how I assess this and how I approach this. But for Palantir, it's somewhere around 1.5 to 2% for me. So I'm just going to put down 1.8 to get this video going. And then we get a 10.42% discount rate. Now, if you read online, if you watch other people do a DCF model, they would typically just use like a flat 10% because that's common. People tell you that you should use 10% or even 11 or whatever it is. I don't find having a static figure here very good because it doesn't represent the current economic factors, the current economic risks, the market risks, and the business-specific risks. So I use two completely market-driven variables, like the risk-free rate by tomorrow could be 4%, and then we have suddenly a discount rate of 9.85. So a valuation, and this is important to keep in mind, that's only a representation of the fair intrinsic value at the time that you are making the valuation. You can't value a business today and come back 3 years later. Well, I valued this company 3 years ago, so it should be worth that much. No, like you have to revisit it whenever you're given a reason to. So that's why I like to use movable pieces here. Similarly, we're going to need another rate, which is the terminal growth rate. And the terminal period is basically out beyond our projection period. So we only project results up until 2034. However, Palantir does not cease to exist as of 2034. It continues to exist beyond that. It continues to generate cash beyond that, hopefully, into perpetuity or until the business dies. Now, at one point, the discount factor just becomes too great that any additional period is non-meaningful. But because we are not modeling to that point, we need a terminal growth rate to use later on. Now, similarly here to the discount rate, people will tell you, well, just use 3%, just use 2%. And that's based on, that's the historical average economic growth of the US. So if you have something beyond 2 or 3%, the implication is that the company is gonna grow faster than the market. And in perpetuity, that would mean that over time, Palantir will become bigger than the whole US economy. Now, that's not the actual reality of the situation, because as I mentioned, the discount factor at one point in time gets too big. And second, there's no guarantee at all that the future beyond 2034 is the GDP growth is only going to be 2 to 3%, or the market growth is only going to be 2 to 3%. So what I do, I don't try to guess what the economy will do. I just use what the market is implying. So I use the risk-free rate as my terminal growth rate. Now, at times, this will be very high as 4.57. Sometimes this will be below 3. It's all market implications. I don't mess with it. I just let the market decide what the implied economic growth is going to be. So that's my approach. Now, we have those two key factors. We have our discount rate, we have our terminal growth rate. Now, we can start looking at the components that will make up the discounted cash flow model. Now, revenue is not an actual requirement for a DCF, but I like to do it because it helps looking at operating income, which is an input into the DCF model. And it also helps us understand margins when we compare and stuff like that. So 2023, Palantir recorded total revenues of 2.225 billion. So let's just format this as accounting. Let's do that. No decimal points to keep it nice and simple for us. Let me just copy the formatting so we don't have to keep formatting everything over and over. Cool. So I'm gonna color this actually, let's just add some color to make everything simpler for us, or visually simpler to differentiate. So this grayed out area here, I can even zoom in a bit. This grayed out area here is static numbers. These are not part of the projections. As you can see, period 0. It's not going to have any implication. It's just there for comparison. So here's the first interesting part. Now, you could try to project revenues simply by adding growth. So let's do year-to-year revenue growth as a percentage. You can also use a different color here just to make it stand out. So what some people will do, they will say like, well, I believe Palantir is going to grow at 30% per year. So they will do something like this. Or actually, let's do that times that. Oh, sorry. 1 plus. So basically, they will do something like this, and then they will just drag that out. Oh, sorry. Of course, that's going to be crazy. Need to do that. There we go. So they will just, well, I believe Palantir will grow at 30%. And they have no real basis for it other than, well, my gut feeling is that they're going to do that. Or I'm bullish, so I'm going to put a high number. And that's what I mentioned in the beginning. Like, just because you have a DCF model does not mean that you have an actual valuation. It only becomes a valuation rather than an Excel exercise when there's actually meaning behind the inputs, when you have a narrative, when you can tell a story. So for example, you can break out the revenue into some of the parts components. You can look at how much is commercial gonna grow, how much is government gonna grow, and why. For Palantir, for example, we know that the Department of Defense is spending 0.5% of their budget on AI. And as we have seen in Ukraine, in Israel, in other parts of the world, AI is going to take a larger and bigger part of conflict into the future. So that would typically mean that the DoD will increase their spending towards AI. So you can break that out and like base your numbers on something. So you can say like, well, Palantir has a 25% market share of that DoD AI spend. So if they increase by 0.5% per year, Palantir retains that 25%, then they will get this much revenue. Stuff like that. You can basically make it as complicated or as simple as possible. Now, the important part to keep in mind here is that the more complex you make your model, the more risk for inaccuracies you start to introduce. Like some people, they will do like 3 decimal points, try to be really precise. And that just like, it looks impressive, like when an outsider looks at it, but it just means that you really have no idea what you're doing because no one is that precise down to 3 decimal points. So you can do like the full revenue, or you can break it down in some of the parts. For example, if we look at my Palantir model here, I do just what I mentioned, like the DoD. I typically use something like comments to say like, well, 77% of Palantir's government revenue comes from the DoD. And the DoD is going to grow its budget by this amount projected by Statista. And then I have a source. And then I really try to think about it like, okay, what kind of revenue growth are we looking at? And then you ask yourself 3 questions that Aswath Damodaran basically preaches, is the 3 Ps. Is it possible? Is it plausible? And is it probable? So you have to ask yourself those 3 questions to keep yourself grounded. But to keep this simple, I'm just going to leave it at 30%. So we're not actually going to value Palantir properly. I'm just making the case in point here. So I'm just going to keep it at 30%. We have some visual representation of that. Now, the next part. Actually, let's do something else first. Let's look at outstanding shares on a diluted basis. And let's do it in millions. And basically, you can denote that everything is in a specific number. So all of these are in millions. So this is 2.2 billion. This is 2.9 billion. And you should probably keep consistent and not mix and match like thousands and millions and billions like in the same model, just to make your life easier for yourself and not have to like do multiplication when you're like summing parts up. Just choose one and stick with it. So the outstanding shares for Palantir on a diluted basis were 2,298 million. So basically 2.3 billion. And now what we need to do, because Palantir does dilute shareholders, they issue new stock. We need to capture that. It's very important to do that. And a lot of models don't properly capture the effects of share dilution, typically tied to stock-based compensation. So let's just do that, and let's just say they dilute at 3% per year. Formatting, so actually do them italic. So 3% all the way out. So just make it simple in this example. So similarly as we did with revenue, we just add up, and we want this to be in number formatting and no decimal points. Well, I do. You can format it however you want. So we start off with 2.3 billion, and by 2034 we have 3.2 billion. shares outstanding. And that's going to be very important, and we will get to that soon. Next part is looking at operating income. So revenue, basically we don't need revenue in a model, but it makes the visual representation a lot easier to comprehend and to view. So let's do income from operations, or operating income. Name it whatever you want. Operating income. Also in millions. So Palantir recorded operating income of 120 million on a GAAP basis in 2033. And the important part now that I like to do, because we are diluting shares outstanding, we also need to add back stock-based compensation, because stock-based compensation is actually included in operating income. It already affects operating income negatively, and that could be, for example, through cost of goods sold. It could be through sales and marketing. Wherever the SBC is allocated, it could be in R&D. All those are counted as operating expenses, and they do affect operating income. However, SBC is not a cash expense. That's why we add it back. Instead, we capture the impact of SBC through share dilution. And this is very important. I don't see a lot of people do this properly. And this was brought to my attention years ago by Arnie Trezzi, that I'm sure a lot of you people know. He made a proposition. He even argued with Aswat Damodran, like the dean of valuation on X, about this, which was hilarious. But we need to add it back because it's not a cash expense. However, it does affect operating income. So we need to add that back. And the way I like to look at SBC is as a percentage of revenues, in order to have a good gauge on, okay, how much is this company diluting? And it makes it really simple and easy to compare to different companies within the same industry. So, for example, as percent of revenue in percent. So Palantir had SBC of 476 million in 2023. Now, you could look at this and see like, oh, that's $500 million, but you don't really have a sense of, is that a lot? Is that not a lot? How does that compare to different companies? Of course, something like a Microsoft is going to have a lot more, but they also have a lot more revenue. So you need some basis of comparison to get a gauge on, okay, are they diluting? Are they issuing a lot of SBC, or are they being really timid with it? So a common thing to do is to look at it as a percentage of revenue. Let's copy the formatting. So in 2023, it was 21% rounded, but we know that Palantir has been decreasing their SBC, and this makes it really simple for us to project it out. So for example, let's say that I believe that in 2024, they will record something like 20%, and then I have it going down I'm just inputting something now. Say they end out at 15%. Like that's what I have it as. This is not, again, not a real evaluation. I'm just inputting stuff and explaining what the inputs are. So this makes it really easy. I think the industry that they're in, Palantir is not actually diluting massively more than any other company in their industry. I think more or less when I made a comparison with like 20 different companies, Datadog, Snowflake, Oracle, stuff like that, the average was something like 22%. So Palantir is actually below the average. However, ServiceNow, which is like what I believe the golden standard within the SaaS space, they have something like 15-16%. So over time, I see Palantir moving there. So you can reason in that regard. So we can simply get our SBC our SBC expense as a part of the revenues that they will be recording. So we just add that up. So by 2034, they will have 6 billion in SBC expense in this example. And looking at operating income, you can also look at margins to get a better comparison. So the margin of operating income in 2023 was, we need percentage again, a lot of percentages, but it really helps when you are trying to build out and just like inputting, well, 150, 160, it's really difficult to get a grasp on what you're actually doing. So looking at percentages and reasoning around percentages makes it a lot easier, and I like to do that quite often actually. For a lot of numbers when I study and research businesses, it gives you a point of reference. So we know that they recorded only 5% of operating margins in 2023. We also know that Palantir is increasing their margins. So you need to ask yourself, okay, what are the margins looking like the next 10 and a quarter periods? And similarly here again, you need to tell a narrative. So we know that Palantir are likely going to be growing their revenues at a pretty fast pace. We're starting to see that acceleration, a re-acceleration now, with the boot camps, with AIP, with current customers scaling up. But the costs associated with that revenue are not actually moving at the same pace. Instead, R&D expenses are slowly, gradually getting higher, but they're pretty stable actually. Similar to sales and marketing, with the bootcamp strategy, they don't need to have a lot of sales expense in order to get that revenue. And when you start to reason like this, you can start to like tell a story about, well, the margins will improve, and here is why. And I believe Palantir will record something like 18%, 19% for 2024. But over time, I have them increasing that and becoming increasingly more efficient. But let's just top it out at 30%. Why not? 35 even. So let's do something like that. Again, this is not an actual valuation. We're only doing an exercise here to prove a point. Like I will have someone be like, the number you put there, it's not accurate actually. Like save those comments, guys. No need for that. Now we actually can get our adjusted operating income because we actually have the SPC expense here. So we simply add those two up and we have our adjusted operating income in millions. You can do that for all the future periods. So off of a base of basically $40 billion of revenue into the future, we will have 19.9 billion of operating income, which is a very efficient business. But keep in mind, 6 billion of that is SPC expense, which again, it's not a cash expense. They don't expend cash to do it. Instead, they dilute shareholders to get that. Now we can start to look at the next very important aspect of a DCF model. Let's just separate these two, which is total tax, basically the effective tax rate. Now, companies outline the expected tax implications in their filings. I think Palantir notes something like 21% as their expected tax rate. But of course, the actual reality of this situation is often very different. And that's why you can keep it simple and just use whatever the company is saying that their expected tax rate is, or you can try to gauge an effective tax rate because companies can defer tax expenses and basically do a lot of accounting to not actually pay the full tax. So Palantir paid on their operating income, they paid, let's see, I have like the numbers. So 20 million in 2033. So we said that Palantir is going to have need to do percentage again. Palantir outlines that they're going to have a 21% in their filings. I believe, I haven't looked in a while. So we can just do 21, or we can expect something like an effective tax rate of 18. So I'm going to use 18. I think that's what I use in my model. No, this is Tesla. The tax rate is, 18%. Cool. So let's use that. And then we have our operating income after tax. But yeah, let's just do that. So no, actually, let's do it this way. That times 18%. Cool. Let's copy this. I want to remove the tax rate just to make it simpler for you guys. So I've copied the value, so I should be able to just remove the tax rate here. Cool. It stays in place. Next. Similarly to the stock-based compensation, that's not an actual cash expense. We have depreciation and amortization. And we add that back because similarly to SPC, it's not an actual cash expense. It's a non-cash accounting expense. And it reduces the operating income, but it doesn't actually reduce cash flows because it's not a cash expense. And that's why we add it back. And you need, when you're doing this for Palantir, it's fairly straightforward and simple because they don't really have a lot of heavy assets. They don't have a lot of things to depreciate over time. So they're very light in that aspect. I think in 2023 it was 33. So similarly, you will have to have a look at, okay, what kind of heavy assets does the business have? How are they amortizing and depreciating it over time? For example, Palantir doesn't have a lot of hardware, not very infrastructure heavy. It's a software company. It's a SaaS business essentially. So it's not a lot of heavy assets here. So I don't know. Let's just assume something like, let's not put a lot of effort into it. I'm just going to put 20 into everything. I don't want to think too much, but that's the way you would approach it. You would have a look at, okay, what are they actually depreciating? What are they actually amortizing? You can try to be fancy and vary it a lot and try to time different things based on what the management is saying in the filings, what the management is saying in the earnings calls and stuff like that. But if you are unsure, trying to be fancy and guessing some very, very precise number, it will only get you in trouble. So make your best estimate and stick to that based on what you can see in the filings and earnings calls and just looking at the assets and expected depreciation of that. Now, the next one that we need is CapEx, capital expenditures. This one is pretty straightforward. It's basically spending on acquiring long-lived assets for like the future growth of the business. Now, for something like Tesla, it could be a new gigafactory. It could be warehouses. It could be a lot of different types of expenditures in order to grow the business, reinvestments into the business. Basically, this whole part is called the reinvestment part, where we look at, okay, how much does the business need to reinvest in order to sustain growth of the business that is implied above here. And that's how we can have a look then. Okay, after all the reinvestment costs, what's left? Like, what's the cash generation looking at? And that's the free cash flow to the firm, which is the model we're actually doing here. Now, next, we have, I didn't actually input anything. So this is going to be a negative number. Depreciation and amortization is an add back because it's removed from operating income without being an actual cash expense. That's why we add it back. SPC included in operating income, it has implications there, but it's not a cash expense, so we add it back. However, CapEx is definitely a cash expense. It's an actual investment into the business. So Palantir, very capital light. As I mentioned before, they don't need to build out factories. They don't need to buy a lot of heavy equipment, the data center, stuff like that. So for Palantir, pretty capital light, as some people would say. So probably going to be very low relative to the overall revenue. So I'm just going to input something like increasingly, but nothing crazy. I'm just making something random again. Don't come at me at the comments. I'm just putting something there. Cool. Next is net change in working capital. And for Palantir, that was 6. And you might ask yourself, well, what is the actual net change in working capital? And the formula is pretty simple. It's net cash flows from operations minus cash flows from operations before working capital. So before working capital in the cash flow statement for Palantir, it's stuff like SPC, D&A, net income, non-cash operating leases, deferred income tax, and stuff like that. So before the actual working capital part of the cash flows from operations statement. So for Palantir, again, pretty capital light. I don't expect a lot of swings here, but they are growing increasingly more efficient. So a positive figure here would add to cash flows. For example, they could be collecting from customers faster than they have to pay costs associated with that, or whatever the case might be for the business that you're valuing. Typically, a negative number here means that more cash is being tied up in things like receivables, inventories, stuff that reduce cash flows from a working capital perspective. So for Palantir, increasingly more efficient. So I'm just gonna normalize some periods here. There's gonna be, of course, periods where they have to use a lot more working capital than other periods. Timing that just like out of thin air is pretty difficult. So you would have to review what management is saying. Your understanding of the business plays a role here, but I'm just gonna do some normalized periods, whatever. It's not gonna be very much for Palantir in either case in relation to the actual revenues. For some businesses, this part has a lot of huge swings, especially when you have a lot of assets and you need to move those assets. Then you have quite a difficult time with the net change in working capital. Now we have all our components to have our free cash flow to the firm. Also in millions. So we just sum up all of these parts that we have here, starting from the adjusted operating income. Then we have the total tax. Then we have depreciation and amortization. Then we have CapEx. And then we have net change in working capital. So that summarized gives us the free cash flow to the firm. And then we just pull that out. And you can even be fancy, do some formatting to show that this is the end result in terms of the free cash flow to the firm. However, we're not finished yet here because, as a discounted cash flow model name implies, we need to discount these cash flows. And that's why we spent all that time creating this discount rate earlier. Now, why is there a need to use a discount rate? Well, we need to represent the risk of future cash flows and the time value of money. So we look at the future. In 2034, $1 is not going to be $1 because there's risk attached to getting that actual dollar. And there's also things like inflation. So the time value of money and the risk of acquiring all these cash flows need to be taken into account. And now is where the period gets important. So we have the discount factor, or actually before we can just have a look at margins. So free cash flow to the firm margins, I'm gonna My camera is in the way of the... There we go. Free cash flow to the firm margins. Always good to have a visual representation of how it looks like. And if you suddenly have like a period where the free cash flow margins are like 80 and what's typical for a business is 20 in a specific industry, you might ask yourself, okay, is this, again, the three P's, is it possible, plausible, and probable? And you'll have to ask yourself a lot of questions if you have some really crazy things here. But as we talked about, Palantir, very capital light, increasingly more efficient. They are raising their margins. Now, 60% free cash flow to the firm margins are probably way too high. And 27 to 47 is very high as well. And I immediately spotted the reason for that is we forgot to put a minus to our total tax expense, because now we are adding the tax back, which we don't want to do. So I'm just gonna do this again, where I take first, let's just copy that. We're gonna do that, but add a minus in the formula, so we get this in negative numbers. I'm just gonna copy that, actually all of these, paste the values, and we're gonna delete this. Now it looks a lot more reasonable. So 27% free cash flow margins in 2023, 33%. Kind of sounds reasonable, even though I just put random inputs here for Palantir. And ending out at 41%, I think, is completely reasonable for Palantir, which is a very efficient SaaS business that has a lot of inherent growth and scale within existing customers, and they don't have to spend a lot of money to acquire the customers or even grow current contracts. So, I mean, all things considered, with the random inputs, this quite sounds plausible at least. Now we have the discount factor, because all of those cash flows are not guaranteed at the value that we project them at, especially the further out we get. So we need to introduce a discount factor, and the formula for that is 1 divided by 1 plus the discount rate. Kind of annoying when I can't see it. There we go. 1 plus the discount rate, and then raised to the power of the period. Oh, let me scroll. Oh, it's actually here. What? Oh, what's happening? Okay, let's try this again. My Excel is acting up. I'm just gonna zoom out to have everything available. So what did I say? 1 divided by 1 plus the discount rate, raised to the power of the period. What did I mess up? There we go. Let's do this into a number. There we go. And as you see, if we add it to the 2023 period that has a 0 in the period, it should say, what? Okay, so because our discount rate is locked here and it's not like in a cell that follows us, we need to actually lock that value. So let me just do that really quickly. You add dollar signs in Excel to lock a specific cell. So now we should be able to do this. So you see, we have the full value because this has already happened. Like the period is 0. There's no discounted impact on this. It has already happened. And it's pretty minimal impact here as well at the 0.98. However, the more we get into the future, the higher the impact of the discount rate. So if the last period, we only get 36% of those cash flows because there's an impact and risk attached to getting that. So if we even lower the discount rate to like 5%, it's almost doubled. So yeah, the discount rate is very important. It has a lot of impact into the discounted cash flow. So that's what we're gonna do next. Discounted cash flow firm in millions, and basically you just multiply the free cash flow to the firm with the discount factor. Yeah, there we go. We can even do there. So you see, this is the same, but at the end period, out of 16.3 billion, after our discount factor, we only get roughly 6 billion of that. So huge impact. Now, remember how I said that we need to keep our attention to actual dilution from stock-based compensation. That's why we went through this phase of actually projecting out outstanding shares on a diluted basis. Now we're going to look at discounted cash flow on a per share basis, because we need to introduce the dilutive effect of SBC, because we can't just add back SBC and then not dilute the periods, because that would like be double counting the implied cash flows from that. So discounted cash flow per share, also in millions. So we just multiply, divide rather, sorry, by the outstanding shares. Can do this, I'll add some decimals. Can I do that? Nope. Let's do this. 2 decimal points. Why am I not getting my... I forgot to choose a currency probably. Yeah. There we go. English US. There we go. So now we have our discounted cash flow to the firm on a per share basis, and that's going to be important to us. It's the end result of all this hard work above here. Let's see, let me just make this general, and I want it to be that color. There we go. Now we can actually start to do the intrinsic valuation. So let's do that. I'm gonna make a little heading here to make it clear what we're doing. So the first thing is we're gonna grab the free cash flow to the firm of the last period on a per share basis as well. So basically everything from now on is going to be on a per share basis, while everything above line 23 here, or discounted cash flow per share, is like on an absolute basis. But from here on out, we're going to do it on a per share basis to make it simple for ourselves. So we just grab the ending cash flows, not the discounted one, but the actual one, because we're going to be discounting this to present value afterwards. Do that divided by the outstanding shares of the last period. So we get 5 here. Actually, let me see if I can just add some decimal points. When you're doing when we're not looking at like thousands and we're just looking at single digits, then we need some decimal points. Now, next is terminal value, which is what we need this for. Because we're only projecting out to 2034 and the company does not cease to exist after that fact, we actually need to capture all the future cash flows beyond 2034. And that's what terminal value is in this instance. Now, there are multiple ways to go about this. I do the typical, it's called the Gordon Growth terminal value formula. It doesn't feature a lot of subjectivity, like it doesn't have a lot of input. So similarly to how I like to use market implications for my discount rate here. I guess they they got moved a bit. Let me just, there we go. So just like I look at the risk-free rate and implied equity risk premium, I let the market decide that. I also like to leave out subjectivity when looking at terminal value. So there is a widely recognized formula for this, which is called the Gordon Growth formula, which is basically we take the free cash flow of the ending period and then we multiply that by 1 plus the discount rate, which we have here. And then we divide it by the discount rate minus the terminal growth rate. What did I mess up here? Did I, let's see, 1 multiplied by 1 plus the discount rate. I guess P1 is our discount rate. And then divided by, yeah, I just needed to add the parentheses. I was like, why does this look off? So now we can actually see what the implied multiple is using our inputs. So we just divide that by, it's the other way around. The terminal value divided by the free cash flow per share of the ending period, it gives us like a multiple. So in this case, using our terminal growth rate and our discount rate as inputs, we get almost 20 times terminal value as we get of the ending. And this represents all the future cash flows that Palantir will be generating beyond this 2034 period. Now, some people, they like to apply using their own multiple. They perhaps want to be conservative. They think the business perhaps is very mature. So they can manually apply something like a 10 multiple to be conservative. Or some people, they envision extreme growth. Like if you're valuing Tesla, maybe you think that Tesla will have extreme growth, which warrants like a 25 times multiple. You can reason around it the way you want, but I like to use the terminal value formula called the Gordon growth formula, because it leaves out a lot of subjectivity, and whenever you can, leaving out subjectivity can actually make things a lot of simpler for you. It leaves out a lot of bias and stuff like that. So that's why I like to use the Gordon growth formula there. Next, we need to bring this to present value. So first we have the present value, PV, of future cash flows. Also per share. Let me just add per share here for clarity's sake. And that's simply this discounted cash flow per share. We just sum all the periods up. They are already discounted, so we can just sum them up. So in total, we have a present value of the future cash flows per share of 10.47, which is what these sum up to. And so the next step is to get the present value of the terminal value, because again, this is beyond 2034. So we need to bring that back to present value as of today for our valuation. And that's also on a per share basis. So similarly to how we did the discount factor, we're going to do, it's pretty much the same formula actually. So we take the terminal value divided by 1 plus the discount rate. Let's see if I can grab that. It's up here. 1 plus the discount rate raised to the power of the final period, so 10.25. And then we get our present value of the terminal value on a per share basis. Cool. Next, we can sum those two up to get our firm value, which is basically the present value of future cash flows and the present value of terminal value. So that's when we incorporate all of our projections here and all the cash flow beyond that into one single firm value here. Next, we have cash per share and also debt per share. Now for Palantir, debt is pretty easy. It's 0. Cash per share, I don't have the cash on hand, so let's just check what I have here. 1.86. So you see a reference to my Palantir Excel sheet. But let's just go with 1.86. Cool. And then final step, we get our intrinsic value per share. So this is basically what our fair intrinsic value is after all of these numbers, all of these projections, all of the implications of the terminal growth rate, the discount rate. Then we get our fair intrinsic value per share. Now, a lot of people confuse this like fair value with a price target. This is not a price target. We don't know what I don't know what the market will do tomorrow, in 5 years, in 10 years. Just to me, based on my inputs, now not necessarily this model here, because I just made random inputs, but what I use this for is I get a reference. Okay, to me, this business is worth this based on my understanding of the business. So a valuation has an audience of one, yourself. This is for yourself to use as a basis for investment, and not to try to convince others that no, Palantir is worth 47 in this case, and that's like objective. It's not objective at all. It's subjective, and the audience for it is yourself only. It's to help you to reflect your understanding of the business. Each input here you should be able to explain, okay, why is revenue 8.2 billion in 2028? Why is the depreciation and amortization 50 million in 2028? Like, you should be able to tell a narrative, a story for all of these inputs, and only then does it become a valuation and move beyond just being a simple Excel exercise. So for fun's sake, we can look at the current price per share of the stock. It's trading at 77.75 currently, and then we can look at the upside, downside to fair intrinsic value, and just do that on a percentage basis. 1 minus, it's the other way around, isn't it? So that 1 minus that, or no, I'm so stupid. It's that minus 1. There we go. Minus 39% to the current price. So assuming that you did all of this and you reached a fair intrinsic value of 47, then you would say that Palantir is currently overvalued by 39% according to your projections. So basically, it's very simple. You can do this yourself. Like, the process of valuation is very simple. That does not make it easy. It's actually very hard to have some semblance of accuracy. Like, just forget about being precise. You will never be precise. Like, the best analyst in the world can't get every number precisely for the next quarter, let alone for the coming 10 years. But given your understanding of a business, you can try to be as accurate as possible to serve as a basis for your investment decisions. Now, as I mentioned, you can make this more or less complicated. So, for example, we have my Tesla valuation, where I break out each segment. So we have automotive, energy, services with FSD, but excluding robotaxi and stuff like that. So why do I do this? Well, the simple reason is I do it because all the different business segments of Tesla, they grow at different growth rates. They have different margin profiles. So I do them separately, and then I bring them all together. It's called a sum of the parts valuation, where each part is summed up at the end. So I like to do that whenever possible. Even for Palantir, I do it on a much simpler basis. I just look at government and commercial, but they have the same operating margins, because Palantir gives us no detailed segmented information for us to be able to actually make some good guesses there. For Tesla, we get some margins, but they are quite poor at it. Something like S&P Global really breaks it out. Like, okay, our indices has 80% operating margins. Our credit ratings has 60, wherever it is. They break it out, so it makes it a lot easier for you. But yeah, you can make it as complex or as simple as you want, as long as it makes sense to you. For me, it makes sense to look at telling the story where I have global auto projections, and then I have EV market projections, and then I assign different market shares and stuff like that. And that's my process for doing things. For example, with Tesla, it might look completely different for a different kind of business, but the core of it all is we need operating income, tax, D&A, CapEx, and net change in working capital to get our free cash flow to the firm. And from then on, it's pretty simple to just make the rest. So it might look very scary doing a valuation, but it's actually pretty straightforward. So also, I've been told that I need to well, first of all, thank you for watching this for over an hour. If you did, congratulations to you. Hopefully you can create one of your own all the way from scratch. That's the goal. I hope I explained everything. If you have some questions, just post it in the comments. I reply to all comments more or less. I read them all and reply to the best of my ability. If you have any questions, feel free to ask. Also, I've been told I need to plug my services more by friends. So on typefcapital.com, you can actually commission me to write you a comprehensive equity research report, like in line with what you would expect from a Wall Street firm, where you can commission me to write about any US equity, and I will provide you like the full Excel with all the data, with the valuation. I will write you a professionally formatted PDF file for the report. I've written the first one just a week or so ago. I think I spent like 80 or 90 hours on it. It was really intense and a really complex business. Now this price is 25% off for like if you browse to this site, if you're in the US. This includes VAT for Europeans, so it's going to be 25% less. Also, you can get the Palantir Excel sheet and financial model where I have like 1,000 rows of data, all the Palantir data that's basically ever been published. It's compiled for you to analyze. I also have my valuation model inside there for you. So have a look at that. And with that, thank you so much for watching, everyone, and catch you in the next one. Bye-bye.